The subject today, do wealthy people really have whole life insurance? If you were to Google search this, or go on YouTube or on TikTok and search wealthy people and life insurance, you would see a million videos pop up. And you might hear a little something like this. For centuries, wealthy families like the Rockefellers have created massive amounts of wealth. They do this with a secret type of trust and a very special type of life insurance that only they and the world's elite have access to. I know the secret to creating generational wealth. And if you want to do what the Rockefellers and wealthy families do, you should get lots and lots of life insurance from me right now. I'm kidding. Promise me one thing, that you would not work with me if I ever tried to convince you to put money into a life insurance policy like that. But on that thought, have you ever seen anything like that or similar to that around the subject of wealthy people using cash value life insurance? I know I have, and sometimes it drives me nuts. So we're going to cover a lot this evening, and really my hope is that you'll learn something new and be in a better position today than you were in yesterday. Sound good? All right, let's have some fun. We'll start with a couple questions. True or false? First question, do wealthy families have access to special types of life insurance policies that only the elite have access to? That'd be false. Question number two, do wealthy families use life insurance for generational wealth? That would be true. You'll see this used commonly. Number three, are wealthy families interested in life insurance for the cash value piece? Well, that's 100% true. So firstly, if you are brand new to whole life insurance, here is a basic high-level overview. We're going to start up top in blue. We've got our death benefit. If you have a life insurance policy and you die, the death benefit is paid to your beneficiaries income tax-free. That means if you have a $1 million policy and you die, whoever your beneficiary is gets a check for $1 million and they don't have to pay income tax on it. Next, we've got your premium and PUA rider. PUA stands for paid up additions. We'll get into that more later. Both of these are how you get money into the policy. This is money you're depositing. And then we've got the piece everyone is interested in, the cash value. So what you'll see with the cash value is that it'll go up in value every year. There's no risk, you've got strong guarantees, and you can access it tax-free anytime if you do things correctly. So that's a quick overview. On to the three things we'll cover today. Number one, why wealthy families have life insurance when they don't need it. Number two, how life insurance is used to create generational wealth. And then number three, how you can copy and paste what wealthy people do if you feel it's a fit for you. The goal of this presentation, of this event this evening, is really to give you details on clients we've worked with for a long time. We'll go through the specific life insurance policies they have and also the strategies they use in terms of how they're using it with their business or for estate planning. And we'll look at real people, real clients that our company has worked with. You'll notice that they all have big policies, but that's not, I don't say that to brag or anything like that. It's just to give you insight as to what wealthy individuals are doing. So before we get into that, in case we haven't met before, hello, my name's Steve. Nice to meet you. That is a picture of me and my lovely wife, Tara. That's from several years ago. I've definitely aged. She doesn't age at all. I am the founder and CEO of IBC Global. We currently serve about 3,000 clients, many of which have a 7-figure, 8-figure, and even 9-figure net worth. And one of our largest clients is a bank. And our goal as a company is to make the best financial and insurance products available to everyone, not just the ultra wealthy or corporations, which we'll talk about today, but really we want to show everyone how you can copy and paste those strategies. So how I learned about this before I started IBC Global is I worked at a firm where my job was setting up policies for corporations. I was very fortunate to pick up this job. This was many years ago. So what that means, set up policy for corporations, is corporations would speak to the owner of this firm. They would say, I want to pay in millions of dollars into these life insurance policies. And my job was to take those millions of dollars coming in and set the policies up for maximum cash value. It was here where I learned a lot. Firstly, I learned why corporations are putting millions of dollars into these products. And when you look at some of the largest corporations in the world, and banks for that matter, you'll see they literally have billions of dollars in the cash value holdings of their life insurance products. I learned how the policies are set up, how we can copy and paste what they're doing for everyone, and then also what life insurance companies to choose. Because you don't need me to tell you that there's a lot of life insurance companies out there. When it comes to whole life insurance policies, where cash value is the goal, I'll typically recommend one of the 4 major mutual companies, simply because we see a proven track record with them, which are Guardian, Mass Mutual, and the other 2 are New York Life and Northwestern Mutual. So after learning everything there is to know about whole life insurance, not everything, but after learning a lot, I decided to go off on my own and start IBC Global, and this is where it all started. We're actually still in this same building, believe it or not. So you can see my ride to work there. I took that into work with a suit and tie every day. Just kidding. But that is my office on the right, that small door there. And that is the building that we're still in. However, if you came here, you would not recognize it as we've renovated it twice now. And today it serves as a recording studio. That's where we are right now. And our team has grown quite a bit too. We're a little bit more than 30 employees today. So who are we going to talk about today? We're going to talk about real clients. First question, will you see the secret strategy that the Rockefellers use? Well, I can't share what they do because I don't work with them. However, we are going to talk about clients that have a net worth of 25 million, 50 million, and 2 that have a net worth greater than $100 million and what they're doing with life insurance. And you'll see that one of them owns a bank that's currently valued between $700 and $800 million as far as their total assets. And we'll look at what the bank is doing, which will be good insight. So we'll look at 4 people. These are not their real names. All confidential information has been scratched, but a lot of the policies are their actual policies along with their actual plan. So we'll cover 3 things for each person. Let's start with Dave and Maria. So these 2 I like a lot. Today, they're worth more than $100 million. They know their stuff when it comes to business. Now, how I met them is Dave initially reached out because he was interested in life insurance for the cash value. What he was attracted to was 1, it was a safe place to put money. 2, he had access to the cash value. And 3, the tax advantages. If you do everything right, it's tax-free. Now, Dave and Maria were pitched on whole life insurance before we had met by other agents, and they didn't move forward because the numbers didn't make sense. I remember the first meeting I had with Dave, what he said to one of the other agents is, why would I do this? It takes me 10 years just to get my money back. Another thing is, they had a secret weapon. That secret weapon was their tax attorney. Now, this person worked with billionaires. They still work with billionaires today. They've written books on tax strategies that are used worldwide. They helped design a life insurance product that is offered by one of the larger life insurance companies in the US. So they understood life insurance better than most life insurance agents. So how Dave and Maria used this person with respect to their life insurance purchase is, if somebody got through the first meeting with Dave and Maria, they'd bring this tax attorney in. And agents did not get past the tax attorney. That's why I got to meet with them, because the other agents didn't get through. So they say, want to meet with a tax attorney? I say, sure. I don't know who this person is. Why not? Like, I've met with other attorneys before. So we start the meeting, and in the beginning of the meeting, she goes, I don't like whole life insurance. She didn't like life insurance either. She mentioned that most whole life insurance products are front-loaded for commissions, which is true. There's products that are not, but she was true in that statement. So during the meeting, she starts grilling me with questions. What insurance companies do I use? What products do I use? What are your commission rates? And the whole time, this is on a Zoom meeting, she's firing these questions at me. Dave and Maria are on there watching. And this is how I felt. I was nervous on the inside. Now, hopefully I didn't show that face during the call. I don't think I did, but yeah, I was shaking. So during the meeting, I just did my very best to answer her questions calmly and thoroughly, showed her options, went over how the commissions worked, explained the tax limits, because I knew that's what she was interested in the most. That was her specialty. And my background with corporations did help a lot too. To wrap the story up, the meeting went well, and they got a policy. And that tax attorney that made me feel like this, well, I ended up hiring her, where now she's our attorney for me personally and also our business. We're friends now. Her name is Elizabeth. You can actually check out podcasts that we have with her on our YouTube channel. So what's the lesson from that story? The lesson is that Dave and Maria had an attorney who was also very knowledgeable in the field of life insurance that helped them with this very important decision. It was actually a $1 million decision because Dave wanted a policy, he got a policy where he funds $1 million per year. He wanted to use the cash value for his business. He really liked how policy loans work. So in this point, how policy loans work. He liked the fact that if he's got $1 million in cash value, earning 5%, and he elects to borrow, call it $500,000, he has a cost to borrow, 5% interest expense, but he still earns 5% on the full 1 million. So he gets that constant compounding. That was very attractive to him. It's a lot like borrowing against a piece of property that's always appreciating. So on the $1 million per year piece, that's how much he wanted to fund his policy with, but he didn't want to bill for that much. He didn't want to be on the hook for writing a check for $1 million every year. He didn't want that. So let's look at his policy. So here we see $1 million per year going in. The plan is currently to move $8 million total into this policy. So he funds $1 million per year. What do you see there in red? There's his premium, $100,000 per year. Remember that chart? Premium and PUA were in red. Here's your PUA. Again, PUA stands for Paid Up Additions Rider. I like to refer to this as a cash dump in. Excuse me, cash dump in. So the goal here was to get as much cash value as possible. How do you do that? Here's the specific steps if you're taking notes. 1, ask your agent for a minimum premium. Number 2, ask what the maximum PUA payment is. Next, I would ask what the top life insurance companies are. We did mention them earlier. Now, the minimum premium, specifically with those top companies, is usually around 10%. So what does that mean, 10%? Well, Dave wanted to pay how much? $1 million per year. What's 10% of $1 million? $100,000. That's how we solved for the minimum premium. He knew how much he wanted to add after we looked at different numbers, and then we backed in to a maximum cash value policy from that point forward. Now, this was really important because the discussions we had with Elizabeth, the tax attorney, really centered around how to get the most out of the cash value. And what she knew is that a maximum cash value policy results in minimum commissions for the agent. So she would always go there during the conversation because she was protecting her client in this case. So back to the policy, the first year, what do you see? 92% in cash value. Remember what Dave said about one of the earlier agents he met with? Why would I do this? It takes 10 years just to get my money back. It doesn't make sense. How long does it take to get his money back here? 4 years. Now, his actual policy, because this is an updated version of the product, his actual policy broke even in year 3, so a year earlier than this. After he funds the policy, he pays nothing in after age 40 in this particular example, and the cash value keeps on growing. He can keep adding money if he wants. In this example, we just stopped after 8 million because that's the current plan. What else did Dave want to see? The policy performance. not just a surface level illustration of what we just looked at, but he wanted to know what the cash value was growing by in terms of rates, the yearly rate of return and the internal rate of return. We'll go through what those are too. So first, let's talk about the rate of return, which is our annual rate of return. If you asked me, what did my cash value grow by last year? This is what I would show you, the annual rate of return. For example, if you had $100,000 in an account and it earned 5% that year, it would have grown to $105,000. That's the 5%. So when we look at this policy, or any life insurance policy, the worst year is the first year. So in the first 2 years, he's negative. That means he's getting less back than what he's paying in. But after that, it gets stronger with time. He's positive beginning year 3. And remember, this is a safe place you can put money that is tax-free. What about the internal rate of return? Well, if you asked, what is my return since starting the policy, this is what I would show. What it mainly highlights is our break even here. So we're looking at total cash flows going in. The first 3 years, I'm negative because I have less money in cash value than what I've paid into the policy. By the 4th year, on the far right, you're at 0.10% because you have more money in cash value than what you paid in the policy. Make sense? I'm negative until I get my money back. It does get stronger with time. Remember that it is tax-free if we do everything right, if we don't trip the IRS guidelines and trigger what's called a MEC with a life insurance policy. So the fact that those rates you just saw are tax-free, how valuable is that? Well, the higher your tax rate is, the more valuable a tax-free benefit is. So Dave is in the highest tax bracket when we look at it, 40%. So if we look at age 40, what do we see here? Taxable equivalent of 9.46%. Does that make me sound smart? No, I hate when big words are used, but this is important because you will see this term regardless of the policy size if you want to see what the taxable impact is. Here's what this means. If you earn 9.46% in a taxable account and you have to pay a 40% tax rate on that account, on the earnings of that account, after you pay taxes, you would be left with 5.68%. Make sense? Cool. So I can take on risk to get 9.46%, or I could just put it in life insurance because I've got the safety and the tax benefits. Full transparency, Dave has both. He's got a lot more going on than just this. And you'll typically see that with wealthy individuals and families. Never are they putting all of their eggs in one basket. They start out in a business a lot of times, but then they expand from there. So his first priority was getting the cash value right. What about priority number 2? Placing the policy in Dave's estate plan. So Dave did not own the policy directly. It was not owned in his name. Elizabeth, the tax attorney, set it up through what's called a family LLC, and that family LLC owns the business. The LLC is registered in a state that has favorable asset protection laws. And then the LLC is part of Dave's trust, which is not even in the United States. He also has assets that are diversified in the US and worldwide. Sound complicated? It is. Why is it so complicated? Because typically we like things simple. Well, when it comes to asset protection, what I've seen with most tax attorneys, especially those that are very good, is they usually have a very complex structure set up for this reason, asset protection. So here's an example of what asset protection looks like. Got a lot going on. You got Dave and Marie up top. You've got the main trust in Europe, and then you've got stuff going on all over the place, and this is outdated too. But then you've got the life insurance there under the family LLC on the bottom. So why do they have life insurance when they don't need it? Because they don't. Cash value is what they're primarily interested in. Money grows safely. They can access it like a personal line of credit for their business, and the tax advantages are very appealing to them. Next, generational wealth. If Dave dies, Maria gets a big death benefit. Here we've got 50 million. His death benefit as of today is like $41 million and change. It's a big dollar amount. When he's 85, it's going to be more like $100 million. That's if he just funds the 8 million. If he keeps adding more to it, it's going to be even bigger. If Maria gets that death benefit of any dollar size, does she have to pay income tax on it? No. What about estate taxes? Because a $50 million death benefit is over the estate tax limit. No. Estate taxes typically do not have to be paid based on the laws today if money is passed to your spouse. And the tax attorney, this is just based on my experience and what I've seen, and if we look up any laws. Next question or next point. What if they have kids and Dave and Maria die? Do the kids get this $50 million death benefit? How do the taxes work? This is hitting on the generational wealth piece. Do they have to pay income tax? No. Life insurance proceeds are always paid income tax free. Do they have to pay estate taxes? They would. Now, this is where a tax attorney typically comes into play. They might recommend a different strategy where it's trust owned. I've seen strategies where a trust owns a big life insurance policy and the death benefit proceeds are used to pay the estate tax. There's a lot that goes on. And a lot of times these change over time as tax laws might change. So this is something that we would definitely keep up to speed on and work with anyone's attorney that is helping facilitate this plan. How can you copy and paste what they do? Number one, interview multiple agents. That's what they did. Number two, bring in a third-party expert who can make sure that you're not being taken advantage of. In their case, they had Elizabeth. Now, if you say, I don't know an expert in the field of life insurance, that's okay. What I would do is start out by just asking a few friends or family members who are familiar with just finance, maybe some experience with life insurance, and ask them for their thoughts. Because a lot of times what happens when I do that is I get an outside perspective that just helps me think a little bit differently or maybe see something that I was missing on my own, even though it was right in front of my face. You ever feel like that? And then number three, get a flexible policy. He can pay how much? Up to $1 million per year. Is he committed to that? No. His commitment is $100,000. A lot of info. Let's move on to the next two family members here, Tina and Pat. So they've got a net worth of about $40 million. They own a pharmaceutical business that generates 8 figures annually. And what I liked about them, they researched whole life insurance for about a year, really understood it, and then decided to move forward, really when they were in a position where they knew they could go all in. So their plan was and still is to fund $2 million per year into policies. We'll go through the specific details. So why do they have life insurance when they don't need it? Well, they wanted to use their policies specifically for a new home initially, and then also their business, or I should say businesses. You'll see what I mean in a little bit. To date, they've got 3 of the 4 planned policies set up, and their policies are just set up as individual policies. Remember where we said Dave's policy is owned by a family LLC? Well, theirs isn't. It's just owned under their name. And why they did that is for convenience. What does that mean, convenience? With the company that they picked, if their policies were owned by a business or a trust, they wouldn't have access to an online account, which means you can't go on your computer or mobile app and see what your values are and request loans. Not a big deal to some people because we can always facilitate that for people. For them, it was. It was a small thing that they wanted access to so they could move quickly. So they started out with the policies owned individually. Now, what's important to be aware of with this is if you transfer ownership of a life insurance policy, especially once there's more cash value than what you paid into the policy, there could be a taxable event there. So we did discuss this, and we also introduced them to Elizabeth and her team, just so everyone's aware of what could happen, and we want to make sure we prevent a taxable event from occurring in the future. So main reason why they have policies when they don't care about the life insurance. Policy loans for the business and also the home. Why they want to use policy loans? The money keeps on compounding, and the cost to borrow, the loan rate is fixed, so fixed forever. It doesn't renew each year at 4.76%. So when interest rates are higher than that, with what they can get through a bank, that's very attractive. If interest rates are lower than that, well, they can just take their policy to a bank and get a line of credit against the cash value. So they know how to play the game, and we'll help them with that. Let's look at the policies. So we mentioned the plan is for 4. Here's the plan. Got Tina, Pat, 2 policies on each. You'll notice that Pat's are bigger because she got a little bit more favorable health rating, and that helped us optimize the performance. The first year, they start with a big old lump sum here, $3.4 million. This was the original illustration that they said, we like that. After the big lump sum, $2 million per year, up until about year 10. It stops when Pat is 65, but they have since we put this together, they have said, we want to keep on paying at least the minimum. So they'll keep on feeding the policy. Now that $2 million per year, do they have to pay that? No, they don't. What are you committed to? Do you remember that from Dave's policy? That minimum premium piece in red, which is about 10% of the total desired payment. The rest is going into PUAs. And on that point, PUAs, that's optional to add. You're not required to throw that money in. Remember that online account they really wanted access to? Well, they wanted access to that so they could just go online and add money at their discretion very conveniently. Adding PUAs maximizes the cash value. So first year, they've got about 92% of what they paid into cash value, which is only an 8% loss. Should I skip over that part? I don't think so, because I wouldn't like it if someone did it to me. 8% doesn't seem like a big amount, but it's a big loss to some people. And it's important just to talk about it, whatever the loss is, whether it's 1%, whatever, we want awareness. Because if you're considering a policy, make sure that you're comfortable with it. And if you're not comfortable with the loss, that's okay. Don't feel forced to do it, or like you have to do it because you've invested so much time or other people are doing it. It's like, no, start when you're ready. Remember, they researched it for a year and then got their finances to a spot where they said, okay, we can hit this aggressively now. They started when they were ready to start. That's the key there. Because that 8% loss is $280,000 with that big lump sum going in this illustration. That's a lot of money to lose. Now, the next year, they get $84,000 of it back. That's the cash value growth. The following year, it grows by another $130,000. And then from that point forward, it is just compounding quickly. And in light blue, that column you see there, that's how much the insurance company is paying them total each year. It excludes their payments. They get their money back in 3 to 4 years. That's when they make up for that first year hit when we look at it. That's the drawback right there too. Upfront hit on whole life insurance. That's it, even when we minimize it. But we've got a gain by year 4 in this example. Paid in $22.5 million in this illustration. Year 20, they've got 38, almost 39 million in cash value, which is a big old gain. So what they liked about this was the fact that there's no risk, the tax benefits, and they can access the cash value like a personal line of credit instead of going to a bank. Remember the first meeting I had with them, Tina said, I'm sick of working with banks. So they just wanted to build their own with this big cash value life insurance policy. Let's hit on the generational wealth. So they don't have kids. The life insurance benefit is paid tax-free. They're very concerned about their employees though. So here is their plan structure. A lot of stuff going on. You've got Tina, Pat, and then all this stuff in the middle, which is all their different companies. So why is it so complex? Asset protection. That's often what we'll see. You'll see life insurance policies at the bottom, both for personal and business use. With these policies, the cash value is used as a tool to complement the growth of the business. Growing the business is ultimately what builds generational wealth for them and their employees. That's what's important to them. The life insurance policy is just a tool that they saw can complement their specific strategy with what they're doing. The death benefit, this can be used for key person insurance. So Tina and Pat are extremely valuable to the company. If they're gone, like, who's going to operate it? The key person insurance is valuable. And remember that life insurance payout is income tax free. Do you remember the combined values of these policies? 58 million in the first year. By year 20, it's over 60 million. Now, full disclosure, they have not started all 4 policies yet. Their total life insurance to date is 30 million, which is still a pretty big amount, right? So the death benefit can be used for generational wealth, both for their business and their employees, which they're concerned about. So how can you copy and paste this strategy? A lot of information. Number 1, get a flexible policy. If you're Tina and Pat, would you want to get a bill for $2 million every year? Probably not. Most people don't like bills regardless of their net worth, at least from speaking to people. Number 2, make sure that you have the conveniences that you want. For them, it was a small thing, online account access. That's important to you. That's what we want to make sure we set up and discuss exactly how we can get that. And then number 3, don't feel like you have to have the perfect estate plan in place before you start. Remember, they just wanted to move quickly and figure things out as they go. The important thing to do there is make sure we have a discussion about that with the tax attorney. Sometimes it might make sense to get a plan in place first, but we don't always have to do that. Good information so far? I know it's a lot. I hope it's hitting on what you wanted to see today. Let's talk about Nick, which is my brother's name, but this is not that Nick. So Nick is a hands-on guy. He owns a company with about 150 employees. Now, he analyzes products and really anything with his money before he commits money to it. His net worth is about $60 million. Think about Nick. He was pitched on whole life insurance years ago, more than just years ago. We met years ago, and before that, he was pitched on it, but he didn't move forward because it wasn't transparent. Here's a question. Do I understand what I'm getting, whether it's life insurance or anything? If it's a no, should I move forward? Would I recommend that to someone else? Probably not, but I want to make sure I understand whatever I'm getting into. So why did he get life insurance when he didn't need it? Like he has a large net worth. He doesn't need the life insurance piece. 2 things really got his interest. The first, net return on his money. He wanted to see what that cash value is growing by net. And then second, positive arbitrage. If you don't know what that term is, we're going to look at specific examples of it. Transparency is what he wanted. So here's what he did. He got a whole life insurance policy. He picked Mass Mutual, and he got a policy where he can continue to add money to it forever until he's 100 years old, or he can stop. He can stop right now if he wanted to. The funding details. When we put his plan together, he had about $5 million just sitting in cash, money in the bank. Now, he didn't want to move all of it into the policy. He moved about $2 million into the policy over the first and second year. Since the second year, he's been paying the minimum, which is about $100,000 per year, and he's got the option to add up to $1 million per year. Want to see the policies? First and second year, what do you see here? $1 million per year goes into the policy. Now, this policy was backdated. So when you see money going in for the first and second year, how long is 2 years? 24 months. Is that how long he had to wait to get the second payment in? No. By backdating it, he got that full $2 million into the policy between 4 to 6 months. So we see this a lot with people that have a lot of money in cash, particularly above the FDIC limits. And they say, I've already got it in other areas. I like life insurance. I just want to be able to get it in faster. This is one strategy that can accelerate the early phase. If we've got more than that, there's some other strategies we might look at. After he pays the $2 million, what do we see? about 100K per year going in. When he gets his money back, between years 5 and 6, let's look at the net return on his money. What is my money growing by? His dividend rate is 6.1%. That's for 2024. When he started his policy, it was not 6.1%. So if we look at this policy and look at the 10th year in this illustration, the dividend is 6.1%. What do you think when you see that? Should your money grow by 6.1%? It's hard to tell when you see money you're paying in, like it's confusing to people. Your money is not growing by 6.1%. Reason why, because the dividend rate is the gross rate. Anytime you see a dividend rate on a life insurance policy, that's not what the cash value is growing by. The same thing is true of the minimum guaranteed rate, which leads to the next question. What's the net return? Like, just tell me what the bottom line is. Here's where I'd look. Net rate. Some life insurance companies do provide additional reports, so you can request it from your agent and see it on an illustration. Some companies don't, so you can calculate it with a calculator, or you can drop it on Excel, whatever is easiest for you. But if we look at the same point in time at year 10, you see the dividend rate, 6.1%. The net rate is 4.35%. So how would you feel if you got a life insurance policy and you thought you were earning 6.1%, but then you see you only got 4.35%? That's false advertising, man. I wanted the good cheeseburger, not that thing on the bottom. Now, with that said, how would you feel if you got a whole life insurance policy and you were told, hey, the dividend rate isn't what you're actually going to get? At year 10, it's going to be around this 4.35%. You were told that and you understood it very clearly. And then it was 4.35%. We're satisfied because expectations were set and also met. Hey, that rhymed. I didn't do that on purpose. The point for him is he just wanted it transparent so he could make an informed decision. He wanted to see what the net return was on his money. Make sense? Cool. Positive arbitrage. What does that even mean, in case you are not familiar with this term or you've only seen it before? Positive arbitrage means you're receiving more interest than what you're paying. We're going to demonstrate that. So Nick doesn't want to just park the money and let it sit and grow. He wants to use policy loans, mainly for real estate. He's really into it. So to see this, we want to see what the cash value is growing by, specifically how much he gets from the insurance company, and then how much he pays to them in loan interest. Because when you borrow against your policy, you're going to pay loan interest. Just like a line of credit on a piece of property that you own, you might get the fair market, you will get the appreciation, whatever the fair market value is, but you also pay the bank interest if you access that line of credit. So we'll look at that, but first, we're going to see specifically how loans impact this policy, because this is important to go through first because it's going to complement the positive arbitrage piece. So first, we've got a policy here. We see what it looks like if he just lets it sit and grow compared to taking policy loans. No loans, just let it sit and grow. By year 5, what do you got? Cash value of 2.2 million and change. By the 15th year, what do you got? Almost $4.7 million. Keep those numbers in mind. Got them? Year 5, 2.26. Year 15, 4.7. You take a $2 million loan. There's your loan balance, $2 million. By the 5th year, your cash value, $260,000. How much did the loan impact that policy? What do you notice here? With no loans, you're at 2.26 million. With loans, subtract 2 million. You're at 260,000. You can do the same thing with the death benefit. The drop was exactly $2 million. Whenever we borrow against a policy, you'll see the cash value and death benefit typically reduce dollar for dollar. Sometimes I'll see the cash value drop more if the loan interest is being withheld if I'm not paying it. Let's pay that loan back. So each year, we're going to pay the loan interest, and then we're also going to make a principal payment. You can pay loans back however and whenever you want. In many cases, it's even optional. Most people will pay them back up until retirement. That's usually what we see. So when it's paid back, your cash value in year 15 is $4.7 million. How did loans impact the value when that money was gone? Year 15, what do you notice? This might be a little bit easier. This is just year 15. Any difference in value? Nope. They are exactly the same. So if I do decide to repay a loan, whether it's in a year or 50 years, doesn't matter how long it takes. I set the terms, meaning I don't have like a 30-year payback schedule or anything like that. When it is paid back, I'll see the cash value and death benefit fully restored. Some companies do things a little bit different. You'll see terms such as non-direct and direct recognition, but for the most part, you'll see similar results there. Does that make sense? How loans work, the fact that your money keeps on compounding. So I get interest from the insurance company, but at the same time, I pay loan interest with a loan outstanding. That'll lead nicely into the arbitrage. So what I don't like to do whenever we're looking at the topic of positive arbitrage is look at the rate. And I'll demonstrate by looking at the rate. Here's why I don't like to do this, is if we go back to the topic of the dividend rate being 6.1%, and we look at year 10, the loan rate's 5%, does that make you think that you're getting a positive 1.1% spread? A lot of times people think that. Here's what I'm getting here. That should be 6.1%. Loan interest rate of 5%, like positive 1.1. Is that actually the case though? No, it is not. So I don't want to feel like this. What should I look at here if I'm looking at rates? I look at the net rate, what we talked about earlier. In this case, the 10th year, 4.35%. But if I borrow at 5%, that's the current rate. This is a variable rate, by the way. Well, now it costs me 0.65%. That goes back to the false advertising, the cheeseburger. I think that I'm getting a positive spread, then I find out I'm getting a negative spread. That's where people get upset with this stuff, with anything. We've got to set expectations properly. So that might be confusing. Here's how I like to do it. This is a bit easier. Compare the cash value growth along with the loan interest. All right, we'll look at it in dollars. First, we'll look at things on a yearly basis. See what's highlighted in yellow? 5th year. That's how much you got in the 5th year from the insurance company, $89,000 and change. How much did you pay them in loan interest? $100,000. The net result, you're negative by about 10 grand. Positive arbitrage? I think not. We're negative there because it costed us more than what we got from the insurance company. We paid more than what they gave us. Make sense? All right. Let's look at the 10th year. What did you get from the insurance company? $137,000. What did you pay them in loan interest? $50,000. You're paying down that loan principal too. In that year, you're positive $87,532. It's the difference. Take the 137, what you got, minus the 50 you paid. That's where we came up with the 87. We do the same thing with year 5. We'd just be negative in that example. Positive arbitrage? Yes, you're positive. You can look at it on a yearly basis. You could also look at it in terms of total money received from the insurance company and total interest paid to them. We can look at when the loan's paid back in this example. So by year 15, your cash value growth is almost $1.36 million. That's the gain, everything above what you paid in. You paid a total of $550,000 in loan interest, but when we look at the difference, you're positive by more than $800,000. We would consider that to be a positive spread. This was something that was very, very important to him, and he wanted transparency around it. The reason why is because when he knew what the numbers looked like, he could use the policy at the best time for himself. The idea of seeing something in the red did not sit well with him. So he could earn the highest net return overall when he factors in the cost to borrow. Make sense? All right. The generational wealth piece. He started his policy He started his policy first and then worked on an estate plan later. So he didn't have an estate plan set up or structured when he started. Now, when Nick dies, his wife gets the life insurance and his other assets. He had a $60 million net worth before getting a life insurance policy. So if he dies in an accident, she all of a sudden has to handle everything. What if she doesn't handle the finances? If that's just not her thing? Well, that can create a situation where all of a sudden everyone is her friend and has money advice for her. It's like, no one wants that stress. This is really where we see a trust help a lot. We see a lot of wealthier families do this to protect their families and kids, the next generation, where the trust can put protections in there as far as how the money should be used. We'll go through an example of that later. So Nick will probably change the beneficiary to a trust at some point in time. We've discussed this several times over the past several years, but he just started the policy by splitting the beneficiaries between his wife and his brother, because his brother is very good with finance and he does trust him in this particular case. So if he lives for a long time, how much money is left? Based on the current path, if he just continues to pay that 100K, somewhere between 25 and 30 million when he's around the age of 90. If he dies a little bit earlier, it'll be a little bit less than that. And that's just the life insurance. Remember that his net worth has mainly been built through his business and also real estate. The life insurance complements what he's doing. So how do you copy and paste that strategy? Transparency. Look for transparency. Understand what the net returns are, not the gross dividend and such. Understand the true cost to borrow. So you've got your loan interest rate, but look at, what did I get from the insurance company? What did I pay the insurance company? The difference is my true net. And then ask to see numbers before starting a policy. You can even ask to see numbers before taking a loan. That's that ongoing relationship. It's very easy to look at updated or what's called an in-force illustration, just an active illustration or projection of your policy. All right, we covered 3. On to the last one. This one won't be as long. Gino. Gino is worth more than $100 million because he owns a bank. He literally owns a bank. I'm not exaggerating. So we're going to look at the plan that he put in place for his bank. So the story about this, I had a meeting with the bank and Gino was not in that meeting. The meeting was with 3 board members. Now, these 3 board members were the co-CEO, who was also the CFO. He's set to take over when Gino formally or officially retires. Then we had a former examiner. So if you don't know what an examiner is, before he worked for this bank, he would examine other banks' books. So he would go through line by line. He could read exactly what banks were doing. He could see where their money was. He saw that a lot of banks had life insurance. He knew what to look for. He's a numbers guy that, again, has experience with banks. You're not going to fool him. Let's put it that way. And then a longtime executive who was very good at asking aggressive questions and getting people up on their toes. Remember the first time I talked to him, called me out of nowhere and starts yelling on the phone, like, what's going on here? But it was a tactic and he was very, very good at it. How do you think I felt? There we go. So I was definitely nervous going into that meeting. Oh, I can't even explain how I felt. But with some help from my sister, current director of operations here at IBC Global, we were able to close the deal. And Gino's bank to date has deposited $20 million into life insurance policies. What's the lesson, or what are some details on this? What kind of life insurance do banks have? Is it life insurance like what we saw in the other 3 cases? No. It's called bank-owned life insurance, or BOLI. Do banks use life insurance the same way as wealthy families do? Yes and no. From a cash value standpoint, no, because banks typically don't access the cash value. Just a buy and hold strategy. It looks good in the balance sheet because it is safe and just continues to appreciate. The death benefit, however, is a big yes. So the death benefit is paid out 100% income tax-free. The bank purchases life insurance policies for multiple employees. The bank is the beneficiary, and this does create long-term wealth. Here are their policies. So they got policies on about 30 of their officers. This was between 3 different life insurance companies, 3 of your 4 major mutuals, Mass Mutual, New York Life, and Guardian in this case. Here's their deposit, $20 million. There's the first year cash value, and there's the first year death benefits. Why do they have life insurance when they don't need it? 2 reasons. Cash value is money on the balance sheet, and it goes up every year. Simple. There you go. Continues to go up in value. What about the generational wealth piece? Well, they've got this huge death benefit that when these employees die, do the employees' families get the life insurance proceeds? No, the bank does. In this particular case, they did set it up where a small portion of the death benefit does go to the officers' families, but the majority goes to the bank. This is paid income tax-free. Just so you know, small businesses and wealthy families are copying this from a generational wealth standpoint. Huge income tax-free death benefits coming in. You can see the dollar amounts there. So how do you copy and paste this? Start a bank. I'm kidding. You don't have to start a bank, but you can do what they did before they made that purchase. You can have multiple people review your policy. And this could be advisors or it could be something simple, family and friends. Number 2, do you remember what companies they started with? 4 major mutuals, 3 of the 4. So always look at the top companies. There's a reason banks go there first. And then number 3, have the life insurance benefits paid to, if you own a business, your business or your family, and you can use a trust here too for protection. A lot of information. Back to the original question. Do wealthy people really have life insurance? Yes. Why? 2 reasons, cash value and the death benefit. Looking at the cash value, it's a safe place for my money. I can access it through the loan feature while the money keeps on compounding. Got a sweet tax benefit. It's tax-free if I do everything right. And then the death benefit, paid income tax-free to my beneficiaries. A great tool for estate planning and generational wealth. A trust can often specify how and when the money should be used. Here's an example of this. Say your kids are due to get a $10 million death benefit from you. It's a big amount of money. Instead of naming them as the beneficiaries, you name a trust as the beneficiary. The trust says that they can use the $10 million for one of the following: school, business, investments, or real estate. But before doing that, they can't just say, I'm using it for business, because they're starting some company they have 0 experience with. The family, or whoever the trustees are, it's spelled out in the trust, has to approve this before the children can actually use that money. So the life insurance proceeds can be used, again, for my family or my business. So if that's a lot of information and you're just thinking, what should I do here? I don't know what to do. Here's a couple simple steps. Number 1, get a life insurance policy if you think it will benefit you. There's no rush when you go through the material. That's step 1. Step 2, the company selection. I'd always, at the very minimum, at least consider one of the 4 major mutual companies because of that proof of performance, not just good-looking illustrations. Being in the industry, you will see that those 4 companies do pay the lowest commissions when you compare them to other carriers, which is good information to be aware of. And then step number 3, make sure that the policy is set up for high cash value and it's also flexible. What does that mean? Want to recap that piece, flexible? We'll see a consistency with all of those plan options. If you said, like Dave, I want to be able to pay $1 million per year. Are you committed to $1 million? No. Your minimum is $100,000. What if you said the maximum I ever want to fund is $100,000 per year? Well, then your minimum should be about $10,000. If the maximum was $10,000 per year, you never want to pay more than that, minimum would be $1,000. See the trend? That 10% minimum, usually we see consistent with the top mutual companies. Some other companies have higher requirements, some are lower. It's not always a 10% minimum rule, but generally speaking, we see that with the top companies. So covered a lot of information. Time for a bonus strategy that comes up a lot that complements life insurance quite nicely if it's used properly. The topic of annuities. Why would I get an annuity? Two reasons: guaranteed growth or guaranteed income. Here's a way I like to think about it. You buy a rental property with cash. Now, this property, you're guaranteed the following: no property taxes, no future expenses, and your tenant is going to pay on time every single month forever. That's all guaranteed. You don't have to think about anything, and you have no future expenses. But you can't access the equity. Sound like a good deal? If you can't access the equity, probably not. You want the income? It probably is. An annuity works a lot like this. For example, I want to guarantee income for my child. I want to make sure they get X amount of dollars when they're 25 years old. And I want it guaranteed. I don't want to do anything fancy. I just want it simple. That's one reason someone would look at an annuity in this case. Another example, I've got money that I don't want to take on any risk, or I want to guarantee growth. Maybe I don't qualify for life insurance. That's often where it's used as a suitable alternative. Or I want to grow my money where it's tied to the stock market, but not invested in the stock market. Here's two quick examples. So we're going to pretend someone is throwing 100 grand in the stock market, and we just used hypothetical returns here. So what do you see in this chart? Up and down and up and down. By year 3, you had 3 years of up, and your 100,000 is worth $135,000. But year 4, something like 2008 happens, and you're back to $100,000. This is where one might look at an annuity instead. I've got this term indexed annuity, where I've got potential upside, but I'm protected from a down market. So, as an example, market goes up, I go up with it. Market goes down. That year we had that 25% dip. My principal is protected. That is a very, very high level overview of an indexed annuity. Typically, when we set these up, we want to make sure we're not attaching any riders that have fees that drag the performance down. Like, no, we don't want that. So another type of annuity, we'll go through this one quickly. It's based on a real case. This is an income annuity. Someone's looking at $720,000 potentially as a deposit. So he's currently 63 years old, a really nice guy. I just talked to him last week. I'm like, this fits perfectly for this presentation today. So really what we wanted to see here is how much income will this $720,000 buy him? If he's going to buy that rental property and it costs 720 grand, what's he guaranteed to receive in income from the insurance company forever? Well, it depends on when you start taking income. So here's our deposit amount. And if he starts income at 63 or 65 years old, he starts at 63. Year 1, he's 63. Year 2, he's 64, and says, I want to flip on the income spigot when I'm 65. It gives him just about $5,000 per month. Make sense? Cool. He says, well, I don't need it yet. What if I wait until I'm 67, or I'm sorry, 68? It's about $6,300 per month. And if he waits until 70, it's about $7,400 per month. And it's guaranteed. And we'll look at the total income on the far right so I can see exactly when I get my 720 grand back. It's an option for the guaranteed income piece. Like life insurance, though, this is something that we want to discuss and see if it's a fit. And this word is extremely important: transparency. Hope you enjoyed the bonus piece. So back to the main question. We're going to wrap up with this. Do wealthy people really have whole life insurance? Oh, yes. Hopefully, you believe me that all of those individuals we looked at are real people that we've worked with for many years, because they are. So let me ask you a few questions. Do you understand, now that you've seen everything we covered today, do you understand why wealthy people use whole life insurance for the cash value benefits? To create generational wealth, and then how you can copy and paste what they do from a product standpoint and also an overall structure standpoint, part of the estate plan and generational wealth. If it's a yes, and you want to work with us, well, you can book a call and we'll definitely walk you through what to do and go through different options. If it feels overwhelming, that is okay. You're not alone. I was extremely overwhelmed the first 15 times I went through this. Don't feel rushed. You can still book a call and we'll walk through what to do, or you can keep on doing research. So we've got a lot of resources. If you'd like to book a call, you can click the link in the description or the chat. That'll allow you to do that. You could also check out our website, ivcglobalinc.com. You could also email me direct. I've got my email up there. You can call our office at the number listed, or you can visit our YouTube channel, which has a lot of videos about a lot of things finance, a lot of cash value life insurance, and there's a lot of case studies too. So with that said, I just want to say thank you so very much again for staying with me all the way until the end on a Monday evening. This covers everything in terms of the live presentation and the what's being live streamed. We are going to transition into the private Q&A. If you're in the Zoom link, we're going to answer your questions shortly. So again, thank you everyone on the live stream. I appreciate your time this evening. Until next time, we'll talk to you soon.